There's a dollar amount out there where earning one more dollar than that costs you about $20,000. Not in taxes, in health insurance. Every other line in a tax code works the same way for you. Cross into a higher bracket and only the dollars above it get taxed more. Not this one. Cross it by a single dollar and your plan breaks somewhere nobody checks. The number that sets your health insurance premium isn't your net worth. It isn't your salary. By the end of this, you'll know exactly what it is and how much of it you control. Medicare doesn't start until you're 65, so if you retire at 45, that's 20 years, 2 full decades where you're buying your own health insurance and there's no employer covering most of the tab without you noticing. I can recite the 4% rule in my sleep. I've read every version of the withdrawal rate debate that exists, and in 10 plus years of consuming this stuff, I don't think I ever once saw anyone connect the two. Nobody said, and by the way, here's what health insurance actually costs right next to the fun math. The FIRE world is great at the exciting numbers. It goes quiet the second the topic turns to plumbing. That gap matters more than it sounds like it should. Your FIRE number is your annual spending times 25. And yes, that 25 is where the 4% rule comes from. So every $1,000 a month of health insurance you didn't plan for isn't a $12,000 annual surprise. It's $300,000 of portfolio you also didn't plan for. That's the part that makes people flinch. This isn't a budget problem, it's a target problem. The bill doesn't just cost you money, it moves the finish line. Put the two price tags side by side and the gap is jarring. Say you've got solid employer coverage right now. A few $100 comes out of your paycheck every 2 weeks. You barely look at it. Your company's quietly covering most of the actual costs behind the scenes. Same plan, same doctor, same you, bought a loan at 50 with no employer standing behind it. The number that shows up is nowhere close. I spent actual years getting my expense ratios down to the 100th%, agonizing over 0.03% versus 0.04%. Meanwhile, the single biggest uncontrolled line item in my entire early retirement plan wasn't anywhere in the spreadsheet. So the obvious question is, how does anyone retire at 45 and afford this? And the answer is the thing almost nobody explains correctly. The mechanism, plainly, your ACA subsidy, Affordable Care Act, is calculated off the income you report for the year, not your net worth, not what's sitting in your brokerage account. Income, the number on the form. Here's the part that sounds backward at first. A person sitting on a $1.5 million portfolio who reports $50,000 of income can qualify for a subsidy. A person with $12,000 in savings and a $95,000 salary might not qualify for anything. The system never asks what you have. It only asks what came in this year. This is one of the only places in the entire tax code where the rules genuinely favor you. The person who did the boring, unglamorous index fund thing for 20 years actually comes out ahead. And almost nobody in the FIRE space says that plainly. Because it sounds like you're describing a loophole. It isn't one. It's just how the thing is written. But you have to know it's written that way before you can plan around it. That knowledge is not standard equipment. So what counts as income here? It's a specific number called MAGI, Modified Adjusted Gross Income. MAGI pulls in your realized capital gains, any Roth conversions you do that year, and net income from things like a rental or an Airbnb. It leaves out money you've already paid tax on, a qualified Roth withdrawal, for instance. Small print, big consequences. There's a specific line where this whole calculation stops behaving like normal math, and it moves a little every year. Modified adjusted gross income. Say that 5 times fast at a dinner party and watch how quickly people find their drinks empty. You've internalized this rule already, even if nobody ever said it out loud. Don't worry about jumping into a higher tax bracket. Only the dollars above the line get taxed at the higher rate. That's true. It's good advice. and it has trained an entire generation of us under the radar to assume every threshold in the tax code works the same gradual way. This one doesn't. The federal poverty level is the government's baseline poverty number adjusted for household size. Cross 400% of it by any amount, even $1, and your subsidy doesn't shrink to match. It can disappear for the whole year, retroactively. That threshold is very much alive right now. The pandemic-era rules that capped premiums and removed the upper income limit expired at the start of this year, exactly on schedule. Nobody extended them. So the original hard cliff is back, and for a single filer, that line sits around $62,600. For a household of 2, it's around $84,600. A lot of FIRE plans got built during the 4 years that cliff didn't exist, which means the number quietly changed underneath a lot of people's spreadsheets without them noticing. Run the math on that last dollar and it stops sounding like a tax rule at all. Lose your subsidy over $1 and the hit runs $15,000 to $20,000. The exact number depends on your household size, age, and plan. For some households, that's the exact $20,000 this video opened with. The effective tax rate on that single dollar is in the millions of percent. Nothing else in personal finance behaves like that. Every other threshold in the tax code is a staircase. Each step up costs you a little more, and you feel it gradually. This one's a turnstile, and a turnstile doesn't charge you for the step. It locks behind you, and it charges you for having walked through at all. The cruelest part, you don't find out the moment you cross it. You find out at tax time, months later, when the dollar that did it is long spent. A system where earning $1 extra can be the single worst financial decision of your entire year. I'll give it this much. That's genuinely impressive engineering. So the next question is the one that actually matters. What pushes you over? Because it's almost never a paycheck. You've retired. There's no salary landing in your account anymore. So how does someone with no job accidentally generate too much income? There are 4 ways it happens, and 3 of them are things you chose to do on purpose for good reasons. One of them, for me, shows up as a text message about a weekend rental booking. We'll get to that. First, the 3 you're actually choosing on purpose. Trigger 1 is the Roth conversion ladder. Picture the fence first. Most of your retirement money is locked up until you're 59.5. The ladder is one way over that fence. You convert money from a traditional IRA into a Roth, pay the tax on it now. Exactly 5 years later, the clock starts January 1st of the conversion year. That money is yours, penalty-free. Convert $40,000 this year, and $40,000 shows up on your return, whether you've spent $1 of it or not. And this is the trap. A conversion counts as income in the year you do it. So the exact tool built to get you to your own money early, that's the very thing that can push you straight over the subsidy cliff. 2 completely correct strategies aimed directly at each other. Almost nobody explains them in the same breath. And the same trap applies to the other 2 early access routes. A 72T plan lets you pull fixed amounts from a retirement account before 59.5 without penalty. A 457B is a government worker's version of a 401k with no early withdrawal penalty at all. Both get you to your money early. Both count as income the year you touch them. You probably won't use either of these 2 personally. Most FIRE folks never touch a government 457B. But the trap underneath is identical to the Roth ladder. Get to your money early, and it counts as income the moment you touch it. Trigger 2 is realized capital gains. You sell shares to fund your year. That's the entire point of building the portfolio. But the gain portion of that sale counts as income. And in the year the market runs hot, selling the exact same dollar amount of shares can generate a much bigger taxable gain than it did the year before. Your spending didn't change, your reported income did. This is the one that stings most in a good year. The market doing great is exactly when your number spikes, without you touching your lifestyle at all. A great year for the portfolio and a worse year for the insurance bill. Same 12 months. The market doesn't do you favors that way. Then there's trigger 3, income you never chose in the first place. Dividends land in your account whether you wanted them this year or not. A $500,000 portfolio in ordinary dividend-paying stocks can throw off $10,000 to $15,000 a year automatically with zero action from you. That's real income, reported on a 1099, sitting right next to whatever else pushed you toward the line. This is the one people miss completely because it never feels like a decision you made. Trigger 4 is the one that gets personal. Picture a retired version of me a few years from now, still renting part of my place out on Airbnb the way I do today. That income has always helped offset the mortgage. It's late December and I'm at the kitchen table with my laptop open. My phone buzzes, a booking request. 3 nights, a couple $100, exactly the kind of thing I'd normally accept without even thinking about it. My thumb's already moving toward accept, and the honest, slightly absurd thought that stops it. I have to go check whether taking this booking costs me 20 grand. My stomach does that little drop you get missing a step in the dark. The side income I built to support the plan is now the thing that could blow a hole in it. And the only difference between those two outcomes is whether I know the number before I tap accept. 4 ways to trip a wire you can't even see, which sounds like a reason to give up on this whole idea. It's the opposite. When you had a job, your income was decided for you. HR set the salary, the W-2 showed up every January, and you just reported what happened to you. In early retirement, for the first time in your life, you decide what your income says. Same spending, same lifestyle, a completely different reported number, depending entirely on which account the money comes out of. There are 3 buckets, and they behave nothing alike. Pull from a taxable brokerage account, and only the gain counts as income. Selling $40,000 of shares isn't $40,000 of income. It might be a fraction of that. Roth principal doesn't count at all because you already paid the tax on that money years ago. And a traditional pre-tax account is the opposite. Every single dollar counts in full. 3 accounts, 3 completely different effects on the exact same shopping trip. I spent a decade obsessing over which bucket to fill first. I never once asked what happens when I try to empty them. Turns out that's the part that mattered most. Most of us spend 30 years building all 3 of these, and nobody ever mentions they behave differently on the way out. So what's actually controllable? Know your household's threshold for the current year before December rolls around. Do your Roth conversions on purpose in years your income is already low, and size them against the actual line, not against a vibe. Same idea with realized gains. Watch them in years the market's been on a run. And before you accept that late December booking or bonus or gig, check the number first. That's the whole information gap right there. Nobody teaches this in school. Nobody really teaches it in FIRE content either, because here's how the subsidy formula works doesn't make a great thumbnail. It's not complicated, it's just never handed to you. And the distance between knowing it and not knowing it is, in a bad year, $20,000. I want to be honest about the part that isn't solved. This threshold moves every year. The rules around it have changed twice in the last 5 years alone, which is a fun way of saying I might be re-recording this section in 18 months. A plan built on today's exact number has a moving part sitting inside it. Research on this is a little messy, but the honest version is that somewhere between 1/4 and 1/3 of retirees end up going back to work at some point. Unplanned costs, health insurance chief among them, are a real, recurring reason why. My actual position is this. Don't build your entire plan on this subsidy staying exactly the way it is today. Build it so the subsidy is upside, a nice bonus if it's there, never something the whole plan is standing on. Which mostly just means knowing your real spending number, ugly line item included, before you hand in the badge. Everything in this video assumes you can control what your portfolio reports. There's one piece you can't. Dividends land on that number whether you wanted the income this year or not. Picture two same-size portfolios, same total return, same year. One dividend heavy, one built for growth. They can hand you thousands of dollars apart in reportable income off the exact same amount of actual growth. The safer portfolio everyone recommends for retirement can undercut the exact strategy you just built. Next video, I break down dividend investing versus growth investing. One of them can save you thousands of dollars of reportable income without changing your actual return. Click the video. That gap could be the difference between qualifying for your subsidy and blowing right through it.